This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And good afternoon, everyone, live on Bloomberg TV and radio, streaming on YouTube and Bloomberg Originals. I'm Katie Greifeld. Alongside me is Bailey Lipschultz. We're doing our best to fill in for Carol Massar and Tim Stenovec. They are out in California. You'll be hearing from them later. But let's get a check on these markets. The S&P 500 trying to hold on to its gains here. We saw very tepid gains last week, Bailey, but we know it's going to be a busy week ahead.
It'll be a busy week. A lot of economic data, as you were alluding to in the break before we joined the airways. Busy IPO week, which is near and dear to my heart, with Klarna, Figure, and a number of other companies selling shares for the first time. So a lot going on. Buckle in.
Buckle in, buckle up. We have a lot to get to in this show as well. And still ahead, all eyes on that labor market after Friday's disappointing jobs report. As Bailey said, we're going to discuss the big week ahead in economic data. We have BLS revisions and inflation readings.
Plus, we'll get the latest out of Paris after French Prime Minister Francois Bayrou lost a confidence vote, forcing France's third change in government in just over a year.
And later, a check on the state of the global commercial real estate and investment landscape. We'll discuss with JLL Chief Executive Kristine Ulbrich. All of that and more coming up. But first, a check on the day's trade and top business stories with Charlie Pellet.
Very much. Do want to begin with a developing story out of the United Kingdom. Heathrow Airport's Terminal 4 check-in area closed and evacuated. Emergency services responding to an incident. Terminal 4 closed and evacuated because of possible hazardous material. That according to the Associated Press, quoting the London Fire Brigade. Again, developing story. We'll keep you posted as we learn more about this story out at Heathrow Airport. We have got the Dow Jones Industrial Average right now trading lower, down 66, drop there of 0.1%. The S&P 500 index higher by 3, little change there, up under 0.1%, while the Nasdaq Composite Index surging 91 points at a record, up by 0.4%. Our Mag 7 Index up 0.2%. The 10-year is currently yielding 4.05%, with the 2-year 3.98%. Spot gold $45 the ounce higher. Spot gold, by the way, at a record 36.32 right now, up by 1.3%. West Texas Intermediate crude oil is gaining 0.5%, 62.18 a barrel, and Bitcoin up 0.8%, 112,262 on Bitcoin. We're keeping an eye on Summit Therapeutics shares. They have plummeted after new data cast doubt on the future of its closely watched lung cancer drug. It is not the first round of bad news for the drug. Summit and its partner Aquino previously released data showing it didn't significantly improve survival, though they urged investors to wait for more information on patients from outside of China. Right now, Summit Therapeutics trading lower by 25.8%. Again, recapping, stocks little changed on the S&P, up now by 3 points, under 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you very much, Charlie Pellet. As Katie mentioned at the top, we're in for a busy week of economic data, and likely the most anticipated update will come tomorrow when we receive a revision of the Bureau of Labor Statistics preliminary jobs benchmark. For more on that update and a look ahead to key inflation results, we're joined now in studio by Molly Smith. She is Bloomberg News economics editor. Molly, looking through the Bloomberg story, Wells Fargo and others expecting the BLS to revise March payrolls down almost 800,000. Other shops like B of A and RBC expecting close to 1 million. To start with, how unprecedented is that, and what is your team looking for tomorrow?
So this would be coming after the benchmark of the prior year, Markdown payrolls by, what was it, over 500,000, I think. So this is definitely, it's not unprecedented necessarily, but we're definitely looking for another sizable downward revision. And this happens when, we see from every month's jobs report that BLS will do monthly revisions to the prior 2 months. That happens all the time. But then this revision is a little different. This is an annual process that BLS does to benchmark the data to another series. And this is something that's taken from the quarterly census of employment wages. So this is a series that it's more accurate, but it's less timely. It only comes out quarterly as opposed to monthly, and it relies on state unemployment insurance records. So this benchmark processing is really important. We get the preliminary number tomorrow ahead of a final number next year. All this to say, data gets revised a lot. This is a very hot topic at BLS right now, something that the Trump administration has very much seized upon, something that they say points to inaccuracies and incompetencies at BLS, but economists and statisticians will tell you that this is very normal. This is something that happens as BLS collects more data, more responses in time, and that's just what we have to do. And you want timely data, this is what happens. You have to, you could put out data quickly, but it's not going to be the most complete set. So this is what happens. This is why we have all these revisions.
Right. And you live and breathe this stuff, obviously. But to your point on the political backdrop here, as you mentioned, the set of data that we're going to get tomorrow, they're more accurate, but maybe a little bit more stale than some of the other labor market sets that we get. But given that political backdrop, given the focus of the Trump administration on the labor market, the BLS, and the revisions that we're getting, I have to imagine that the stakes are a little bit higher. The scrutiny is higher than normal on this specific set of data.
It's very tense right now, for sure. It's been a tense couple of weeks at BLS for sure. And, ever since Trump fired the commissioner after the July jobs report, that one had some big downward revisions to the prior 2 months. Again, this is something that the administration says means that the agency isn't doing a good job, and they say that the data needs to be accurate and fair, and it can't be manipulated for political gains. Everybody would agree with that, but also most people would tell you that that is the status of BLS data already, that there is nothing wrong with it, that this is just the reality of what it's like to collect economic data in this day and age, and that if you want the data to be more complete earlier on, you need to invest in better data collection methods to get businesses and households to reply more promptly to surveys, and that's really where the investments need to be made, not necessarily axing the people who are in these positions and who have the institutional knowledge of how a lot of these processes work.
Well, you touched on the big underlying issue there, and that is collection rates. I mean, we've been talking about revisions to the labor market data for a while. I remember having a very similar conversation with Acting Labor Secretary Julie Su about these big revisions that we were getting. So this has been going on for a while, and the fact that the initial collection rates have just been going down over time, it seems like that's at the root of a lot of what we're talking about.
Right. And who you're just mentioning, Julie Su, she was acting labor secretary in the Biden administration. So, yes, this has been going on for a bit. The Trump administration obviously would concur with that as well, that the revisions are they take a lot of issue with this, and that I think everybody wants more accurate data, more timely data. But there are just restrictions in terms of how to go about doing that. And in order to get these collection rates up, I mean, that's really where so much of the conversation should be focused right now. And I think that's what BLS is really trying very hard to do, especially when you look at the establishment survey. Those collection rates for the first month of sampling very consistently been in that 50 to 60% range now for several years. It gets up closer to 80, 90+% by the time they survey firms in the second and third time around. But again, that's the trade-off. Do you want the data up front that maybe isn't the most, comprehensive set because we all want things that are so timely? Or are you willing to wait a while for something that maybe has more of the responses and perhaps is closer to the accurate number? So that's the trade-off.
And Molly, that's not the only set of data we're going to get. Looking ahead to PPI and CPI, what's the expectation? What should investors and kind of economists, what are they looking for? What's going to stand out?
Yeah, so the inflation data, I know it seems like it's kind of like in the background this week, which is weird. Normally it's like, oh my gosh, CPI, like hair on fire kind of week, but not so much this week. More eyes coming out tomorrow with the benchmark data that we've been talking about. I think honestly, though, that is really the right read, though, right now, just given that, especially whether you're thinking about this in the context of the administration or the context of the Fed, it really is the labor market right now that's driving so many of these decisions, and that the Fed, very much priced in to have a 25 basis point cut at the meeting next week. And this is, again, because of the weakness that they're seeing in the labor market data. The conflicting side of that, though, is that inflation is still running well above the 2% goal. And are you in the camp, that you think that this is going to be a persistent inflationary pressure coming from tariffs and other economic conditions right now? Or are you kind of hoping, really, that inflation is going to fade down and that you really just need to step in to support the job market? So that really is the tension at the Fed right now as well.
I think that tension is really interesting. Like you said, I mean, it seems like it's the labor market that is in the hearts and minds and the people making decisions at the Federal Reserve. But that feels like a handoff, right? I mean, certainly a few months ago, certainly at the beginning of summer, it felt like it was the inflation picture that Jerome Powell and company were really worried about. But the labor market has maybe supplanted that. Yeah,
no, that definitely is where what is driving Fed policy right now. And you've heard a lot more Fed speakers talk about this, especially since that July jobs report, which came out a little over a month ago. And that really has sparked a lot more of the conversation around, resuming cuts, and not just for September, but for the other two meetings the rest of this year as well. Even some people saying, who knows if the data tomorrow on those benchmark revisions is so bad, could it even spark a discussion for a 50 basis point cut in September? And I find the timing, all of this, just so eerily similar to last year. It's very deja vu when we had a couple of weak jobs reports going into that September meeting, prompted the 50 basis point cut, 2 quarter point cuts for the rest of the year. But at that time, it was more about the unemployment rate moving up, and now it's more about payrolls. Time is a flat circle. It certainly does feel similar to last September. We'll see, of course, if they actually go with the 50, but that'll depend partly on what we get in the next few days. That is Molly Smith. She is an economics editor over at Bloomberg News, of course, walking us through what is going to be a hefty week when it comes to the economic outlook. But let's switch gears here and bring in Bloomberg News national security team leader Nick Wadhams. Nick, we know it was a really interesting and consequential past couple of days with the recent immigration raid at a Hyundai Motor Solution battery venture in Georgia. This was, of course, was just one of recent actions that has targeted the workforce building these sorts of products done by foreign workers. Nick, what do we know so far?
Well, there's still a lot we're sorting through, including what the immigration status is of those workers. But, the broad brushstrokes are that this has really sent a shockwave through the foreign investment community. For so many years, U.S. states like Georgia have really urged foreign companies to come and invest in the U.S. and build their products in the United States. And in this case, Hyundai was really courted very heavily. The idea being, listen, we want these cars made in the United States. We want jobs. We want that output here. So the companies had been brought in, and now you have this real cross current, a contradictory message, which is, okay, you bring those factories into the U.S. and now ICE and the Trump administration are essentially targeting them. So that's going to cause a lot of companies to sort of sit up and say whether, ask the question of whether the foreign investment is worth the risk. So we know that there's a South Korean delegation coming to secure the release of those workers. A lot will depend on their immigration status, so we should know more by the end of the day. But needless to say, this is causing a lot of companies to stand up and take notice.
And Nick, one question to stick here. Is it at all surprising for this to take place in Georgia? We've seen kind of a focus seemingly on typically Democrat-leaning states as it relates to ICE raids and other kind of steps taken by the Trump administration.
Right. Well, I mean, the interesting thing here is I think there's something a little bit different at play, which is in some ways you may have found some officials in Georgia had the ear of the Trump administration. There's some reporting out there that there were concerns from unions that a lot of the jobs at this plant would not be unionized. And so some of the concerns around the potential status of the folks who were coming to work at that plant were raised with the Trump administration because potentially they weren't unionized. So, and which is its whole other element in an interesting story where you've had that, the unions, which were typically a bastion of Democratic support, have really flipped over to Trump and have his ear. So it seems to be a little bit more that's what's at play here rather than the Democrat versus Republican, sanctuary city and blue or red state situation.
Well, Nick, you also touched on another interesting angles, and there's so many different ways you could attack this story here, but It's interesting to hear you say that, some of these foreign companies are standing up and taking notice here, and they're concerned about their workers. It seems like this rate in particular, and maybe some of the other actions that have been taken, stand at odds with some of the Trump administration's stated goals here to bring this sort of manufacturing back to the U.S. and make some of these critical products in the U.S. But if you have foreign companies worried here and maybe hesitant to invest, it seems like that would be at odds.
Right. I mean, and I think what you're seeing across the board is a lot of, when you look at foreign countries, there's a lot of trying to sort through what the Trump administration's message really is, because this is not the only place where there are a lot of cross currents. You look at Russia, for example, where the president has talked openly about his affection for Vladimir Putin and suggesting he might step off the gas on Ukraine, but then saying he may impose secondary sanctions on China, and has done so with India. You had the president meeting with the Indian prime minister and promising a very warm relationship. Then that apple cart has really been upset. You obviously have his image as a pro-peace president. He says he's solved 7 wars, and then launches a strike on a boat allegedly carrying drugs in Venezuela. So, it's not only Americans, but also foreigners looking to try to make sense of this administration. And when they have money on the line, especially a putative ally like South Korea, it's going to add to those questions even more. And that's why we are hoping, to see some result as a result of this delegation that's coming into town today to get some answers.
Yeah, Nick, is there any expectation on how long some of these factors or things will take to play out, just given that you are in D.C. right now?
Well, I think there's a lot of sense that folks are going to be buckling up for a long ride through the Trump term, because there are so many forces at play and so many folks who have the president's ear. Especially in this case, it's just, as you mentioned, it is so contradictory when you have the president saying, hey, bring those jobs to the United States. We want that investment in the United States. If you want to avoid tariffs, the way to avoid tariffs is to produce your products in the United States. Well, what happens when it tends to be a plant that's making EVs? In the Hyundai case, and obviously, so the president wants that investment, but he doesn't like electric vehicles, so you have that cross current as well. Suffice to say that when companies are looking at much longer time horizons, they're much more wary about investing in the immediate term.
All right, Nick, great to get some time with you. Really appreciate your reporting. That is Nick Wadhams. He is our Bloomberg News national security team leader, joining us from Washington. Meanwhile, we turn back to what's going on in these equity markets. It is a Monday trading session underway right now. The S&P 500 up slightly right now, but it once again feels like just this wait and see sort of vacuum that we're in. We know that we're going to get some consequential labor market data tomorrow in the form of revisions, maybe a little bit stale, but still politically sensitive there. And then a double dose of inflation. Double dose of inflation,
Katie. We also do get the big Apple event. So the biggest drag on the NASDAQ 100 in terms of points is Apple, down about 0.9%. So pulling back the NASDAQ 100 by about 17, 18 points. But we are seeing what's broadly on the surface of momentum day. Looking on the terminal, factors to watch: momentum and growth outperforming. We're seeing a pullback on dividend and value stocks, though, as you mentioned, not really a ton going on. It seems like we're waiting to see what that economic data looks like. And obviously, again, we do have kind of uncertainty around what that jobs data revision will look like and what inflation is going to signal.
Indeed. For better or worse, this feels like a market that is very focused on the Fed's next step. Of course, we're also counting down to that Fed decision. But a lot coming up on Bloomberg Businessweek. Up next, we're going to head to Paris and check in on the state of the French government. I hear that there's some turmoil over there. Don't go anywhere. This is Bloomberg Businessweek.
Tech markets all day long here at Bloomberg. We've got the Dow back in the green, has been swinging between gains and losses. Right now looking at a 20-point gain on the Dow Industrials. That's an advance of about 0.1%. S&P 500 index up 12 at 64.93. That is a gain of 0.2%. The NASDAQ Composite Index trading at a record 21,822. NASDAQ up now by 0.6%. The 10-year yielding 4.04% with a 2-year, 3.49%, while gold is up $47 the ounce, up 1.3%. Gold at a record $36.33 the ounce, while West Texas Intermediate crude up 0.6%, $62.26 a barrel. Bitcoin up 1%, $112,400 on Bitcoin. Apple shares trading lower by 1%. Apple launching that iPhone 17 tomorrow, and Nvidia's price target has been cut at Citigroup while maintaining a buy rating. The target now $200, down from $210. Nvidia shares up 1.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thank you for that update, Charlie Pellet. And as we've been teasing, of course, there is certainly a lot to talk about when it comes to the French government. The news coming today that French Prime Minister Francois Bayrou has lost a confidence motion in Parliament. This should force the third change in government in just over a year. So let's set the scene with Bloomberg Daybreak Europe host Stephen Carroll. He joins us live from the Paris bureau. So what are the different factors that led us to this moment? As I said, the third change in French government in just over a year.
Yeah, I mean, there's sort of if you lose one prime minister is careless, you know, but you lose two is perhaps an indication that something bigger is wrong in French politics. And the problem has been, since Emmanuel Macron called a parliamentary election, a snap parliamentary election in June of last year, is that essentially nobody has a majority. The parliament split pretty much into three blocks: on the left, the centre and the right. Emmanuel Macron's party is in the centre. They've been trying to manage with a sort of a working minority situation, and it just hasn't worked. And that's why we're on a third prime minister. It comes down in each occasion to how the government is trying to pass a budget. At the moment, we were working on the budget for next year. The proposal from Francois Bayrou was a fiscal consolidation of 44 billion euros. So some tax rises, some spending cuts. The idea was to tackle something that he's been talking about for actually decades at this stage, which is trying to get France's ballooning debt under control. Something that's been exacerbated by a rise in bond yields globally has been the fact that the cost of servicing France's debt has gotten so much worse. He laid out the plan, first of all, in July. He left the summer open for negotiations. 2 weeks ago, he called a confidence vote, which is his right as a Prime Minister to do, but he didn't win a majority in Parliament. A majority of MPs voted against him, and so that means that he is now going to resign as Prime Minister. He's going to be going to the Elysee Palace to meet President Emmanuel Macron tomorrow morning to present his government's resignation, as is foreseen in the Constitution, and then it will be up to Emmanuel Macron to name the next Prime Minister, who will face the same fractured Parliament to see if perhaps somebody else might be able to do better and might be able to actually get an agreement on a budget.
Well, where does he turn? Who are the likely names? What actually could be named, or who could be named that would actually kind of unite some part of this Parliament?
It's a great question, and it's not the first time we've had to play this game, and it's now at this stage turning into a bit of game of guess who, because we have people ruling themselves out on live TV. As I'm speaking to you, the head of the centre-right party, Les Républicains, said that he doesn't want to be Prime Minister, so that's one person we shouldn't expect to get the call from Emmanuel Macron. Really the focus, though, has been around whether or not Emmanuel Macron will look outside of his political grouping. He has chosen previous prime ministers from within his own party, from Francois Bayrou, who was from a similar centrist party that was allied with his, and then there was Michel Barnier before that, who had traditionally come from the centre-right party. So the focus really is whether or not he may pick from the centre-left, from the Socialist Party. That would be what would change the parliamentary arithmetic in the National Assembly. That could win over more votes and make the possibility of passing a budget that little bit easier. Now, the Socialists are well aware of their position of power in this. They put forward an alternative budget ahead of this motion of confidence, which included some fiscal consolidation, about half of that of what was given in Francois Bayrou's proposal. So still the idea of cutting back on some spending, some new taxes, including on fortunes of over 100 million euros. They wanted to implement a wealth tax. Those are proposals that they say they're ready and willing to lead a government, but they want to do it on their terms. They want to put forward their budget, and they want to lead a government that's going to include the Socialists and the Green Party. So Emmanuel Macron has a choice. He could open that door to them, or he can go back to some of those from perhaps within his own movement, the likes of the current Defence Minister, Sébastien Lecornu, is a name that's being mentioned quite a bit. We've also got the Justice Minister, Gérald Darmanin. He's said to be interested in the job as well. And a host of other names that will, people will want to put themselves forward for this role as well. But the question is whether anyone can do any better than the last 3, 5 or 7 prime ministers that we've seen under Emmanuel Macron's presidency.
Yeah, I would imagine that would be one of the big questions here. I want to dig in a little bit more to some of the proposals to try to answer that question, because you mentioned the wealth tax, of course. Bayrou, of course, had proposed 44 billion euro worth of spending cuts and tax hikes. He also floated the idea that maybe they would cut 2 public holidays as a way to reduce costs. I have to imagine that, too, was a very tough pill.
Yeah, I mean, I think you can imagine how that went down with the French public. By the way, there's a series of impromptu parties being held. They're being called leaving drinks for Francois Bayrou in various cities around France this evening. So there are hundreds of people gathered in different cities around the country celebrating the departure of the Prime Minister. So even in times of political crisis, the French will find a way to be French about it. And this is something that we can rely on looking at the idea. Indeed. In times of great uncertainty, there are things that you can rely on about political turmoil in this country. But, I mean, the question remains is that who could do something that's better or different. A lot of Francois Bayrou's proposals were about freezing things like income tax thresholds, freezing benefits payments at current levels. There wouldn't be automatic inflation-linked increases next year. That was to try and control it. He had wanted to front-load the fiscal consolidation, something that markets certainly that would be welcomed by markets, because we have seen this pressure on French borrowing costs as well. The Socialists, as I say, want to do it at a slower pace. This is, and Bloomberg Economics have highlighted this again recently, this is not a fiscal crisis right now. It is a political crisis. First of all, the current budget runs to the end of the year, so you've got still several months for somebody to try and cobble together a plan for what happens next year. If they don't get a budget agreed, we don't have a shutdown in this country. What happens instead is the current spending plans simply get mapped on to next year. Not anyone's ideal scenario, but not leading to a situation where there would be massive changes to either how services are provided to taxpayers in this country or how markets would be perceiving the situation down the line. But nonetheless, Francois Bayrou has repeated, and I think most market participants would agree, long term this problem does have to be addressed, and none of the remedies look particularly attractive. Cutting bank holidays was a particularly surprising idea, but Francois Bayrou, when he announced it, said, look, everything's open to negotiation. If you come up with a different plan, I'm willing to listen to it. None of the other political parties want to engage, though, with that sort of discussion.
A lot of unknowns that we will figure out at some point in the future. That is Stephen Carroll working the late shift from Paris. He is the host of Bloomberg Daybreak Europe here on Bloomberg Radio. Shifting our focus to the energy markets, on Sunday, OPEC Plus decided to further increase their oil production. For more on that, we're joined now by Dr. Ellen Wald, president of Transversal Consulting and a senior fellow at the Atlantic Council from Boca Raton. Dr. Wald, oil prices moving a touch higher after this announcement. Was it all kind of baked in and expected? What's the real takeaway from here?
I think that markets probably expected a slightly larger increase. And so when news of this came in, we were actually seeing prices move higher as a result of those expectations already being baked into prices. The other thing that has come out actually today is that a lot of the countries that are involved in this increase are actually already overproducing their quotas. And so they've all submitted schedules for reducing production in order to kind of compensate for the overproduction that they have been committing. And so it's going to look like actually we're going to see a little bit less oil on the market from some producers, but Saudi Arabia is going to put more oil from its wells on the market.
Yeah, with that in mind, what's the driver there? Is that just strictly Saudi Arabia having the biggest seat at the table and making the decision and kind of driving the ship?
Saudi Arabia definitely has the biggest seat at the table and is absolutely driving the OPEC Plus ship right now, especially amongst those countries that had committed to voluntary reductions beforehand. So these are all, actually rolling back voluntary extra cuts that they had made previously. But I do think that Saudi Arabia is looking at the forecast from its people at OPEC, and they're showing that we're not actually as oversupplied as some people think we are. That's what they're looking at. And so they're looking at a way to, they're looking to add oil to the market. They're looking to increase their revenue, and they're more likely to be able to do that at this point by selling more oil as opposed to selling less oil and trying to kind of jimmy the prices higher. It would be very difficult for them to actually get prices to go higher based on cuts. But if they can just sell more oil, even if prices are a little lower, they're likely to actually make more money. And then you have this whole issue with Russia and sanctions and tariffs. And so I think what they're looking to do is not necessarily regain market share per se, but they're looking to fill gaps in countries that are being pressured to cut back on purchases of Russian oil.
Yeah, definitely a lot of different cross currents there when you lay it out like that. Ellen, it is interesting that heading into this weekend, you had analysts over at Goldman, also at JP Morgan, basically warning Saudi Arabia and its partners that they could risk unleashing what would amount to a supply gut if they didn't cut production. Obviously, they did not cut production. They boosted it maybe by less than expected. But give us the current state of supply. Are we at risk of a supply glut?
So it's interesting. I think that there are definitely a bunch of different forecasting agencies and banks that do see us as either entering a supply glut or soon to enter a supply glut. And then you have OPEC. And based on the amount of overproduction that was actually going on, I do think there is probably more oil on the market now than the numbers that most people are looking at are saying. So if we're actually in a point where we're in the kind of supply and demand balance that we're in, but there's actually more oil on the market than we think that there is, we may not actually be headed for quite a supply gut as these banks have been forecasting. Of course, these things depend on, how global economies go. Are we going to see, slowdown in China or something of that respect? And those things can all act to change, the supply and the demand situation. But I do think that OPEC is not seeing the kind of dire oil glut that Goldman and other banks are looking at.
And Ellen, just in about 15 seconds, what does this mean for the end consumer of pretty much any energy product?
So, for U.S. consumers, we could see gasoline prices going down a bit, but I don't think that that's really all that dependent on OPEC at this point. We're really in an area where we're producing a lot of oil in the U.S. I do think we need to look carefully to see if that production is actually going to start declining, because that could have a more immediate effect on energy prices. In terms of electricity prices, we are looking at higher prices.
Right.
But that's another story.
All right, great to get some time with you. That is Dr. Ellen Wald. She is president of Transversal Consulting and a senior fellow at the Atlantic Council. For those keeping track at home, Brent's currently trading at $66 a barrel. You're listening to Bloomberg Businessweek.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all advancing right now. S&P higher by 10. That is a gain of 0.2%. Wall Street's piling into bets that the Fed will be cutting rates next week. The Dow now up 28, up 0.1%. NASDAQ trading at a record 21,804 right now, up 104 points. The NASDAQ Composite Index up by 0.5%. Our Mag 7 Index higher by 0.3%, with the 10-year currently yielding 4.04%, the 2-year 3.49%, and spot gold up $47 the ounce, up 1.3%, $36.33. Gold, by the way, looking at a record. West Texas Intermediate crude oil 62.35 a barrel. WTI right now up 0.8%. Merger Monday with PNC Financial Services agreeing to buy First Bank Holding for about $4.1 billion to add $26.8 billion in assets and branches in Colorado and Arizona as one of the nation's top regional lenders adds to its coast-to-coast footprint. PNC Financial down now by 0.6%. For on-demand news, news 24 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you for that update, Charlie Pellet. Let's check in on the real estate market and specifically commercial real estate. We're joined now by Kristine Ulbrich. He is the president and CEO of JLL. He is joining us now on Zoom from Frankfurt, Germany. Kristine, great to have you here with us. And you have a really unique perch, of course, a very global perch when it comes to the global commercial real estate market. And so with that in mind, how does the U.S. stack up versus the rest of the world? Is this one broad picture that you can paint with a broad brushstroke, or how much dispersion is there when you take a look globally?
Well, when you look at the Western mature economies, there's the absolute performance and there's the relative performance. The absolute performance of the U.S. is okay. It's improving over the last couple of quarters against what we have seen during the trough at 23. But then there's also the relative performance against the other Western mature economies. And compared to that, the U.S. is doing really great and is an attractive area for investment for international investors.
Are there parts of the market that you see, I don't know, better set up to succeed, whether that's manufacturing, industrials, office? Where are you seeing the strength right now?
Well, again, on the offices side, we saw a really deep trough post-COVID and the discussions around what is the need for offices going forward. But what we have seen over the last couple of months that more and more of the large corporates are asking their people back into the office. In fact, when you look at the Fortune 100, more than 54% of the Fortune 100 companies in the U.S. expect their people back into the office for 5 days a week. And that has obviously resulted in a steady increase in demand for high quality office space. And as we are coming from a very low base, there's still a lot of runway for the offices sector. With regards to industrial, usually a very strong sector, but still a little bit shaky from the impacts, the unknown impacts from the tariffs around the world. So that is still something where we hope that we get a little bit more certainty into the market, and then that asset class will recover as well.
Well, Kristine, you talk about the return to office post-COVID. Obviously, top of mind for investors, consumers, and managers is the impact of AI. How are you seeing companies within office thinking about whether or not they can reduce their in-office footprint, not just kind of to account for people returning to the office, but if you're implementing AI and you need less white-collar jobs, presumably that means you need less office space.
Yeah, that is obviously a big discussion. I would say this is still too early to really make clear predictions what's going to happen. At the moment, it doesn't have any negative impact. You can argue it's at the moment almost the opposite for the US at least, where we have a lot of investment into AI and a lot of new staffing coming into the tech companies. But going forward, that could become a topic. But as I said, we are still in the early innings where AI is really showing its impact. And so we cannot say how that will play out longer term.
Yeah, certainly a lot of investment into AI. Still unclear, of course, what that means for the worker and the buildings that they work in. But I want to wrap in Federal Reserve rate cut expectations to this conversation. It seems like a done deal that we're going to get a rate cut from the Federal Reserve in less than 2 weeks' time. What happens for the rest of the year? Unclear. But how is that conversation and these shifting rate cut expectations sort of translating into what property owners are considering doing with their real estate?
Well, simply speaking, when you have interest rates expected to come down, that will have an impact on pricing because the cost of capital for those real estate investors will come down, and therefore they can afford higher pricing. And we had that debate now for many, many months, first whether it will come further up and then when it will come down. Usually these smaller changes in interest rates, and especially the ones which are expected, don't have a massive impact because people are adapting to it. What the market doesn't like is any rapid movements, and especially those unexpected movements. So going forward, those 1 or 2 rate cuts, which are now expected for this year, they will support the overall kind of environment for real estate investment, but it will not have a massive impact.
Yeah, well, one thing we were talking about at the top of the show is the impact of kind of immigration and the lack of immigration or some of these ICE raids and how that impacts manufacturing. What's your read of building and investing in Donald Trump's kind of push for manufacturing and bringing manufacturing back to the U.S. if there's so much uncertainty around tariffs and the ability to actually get employees from other countries here in the U.S. to work?
Well, that is certainly an aspect of uncertainty. I mean, before we had all those debates about tariffs to the U.S., or from the U.S. to other countries, we already had a shortage of skilled labor in the U.S. So that hasn't become much better since then. So for everybody who wants to invest into the U.S., the question, where will they find the skilled labor, is a big debate. And the uncertainty now about immigration, not only the pictures we see on TV, but also the question around whether the most talented people around the world who usually aspire to come to the U.S. will see the U.S. as kind of their destiny, or whether they want to have their careers elsewhere is now an open question. So whatever going forward helps to calm that situation down will obviously then also help to bring more certainty for those who want to invest into the U.S.
We're talking to President and CEO of JLL, Kristine Ulbrich. Kristine, just want to ask about something top of mind here in the U.S. is potentially the IPO or re-IPO of Fannie and Freddie. How are you thinking about that? What is your view on the potential impact, not only as it relates to U.S. home buyers, but the entire ecosystem as it relates to real estate, if these are two companies that end up getting out of government conservatorship and into the public markets?
Listen, I think we will deal with that situation when they're a private company, as we have dealt with the situation when they were a public company, publicly owned company. So it is a very important instrument for the U.S. housing market. It plays a huge role. And I'm sure that in any format of an IPO, whoever will be the owner of those entities will try to prevail the success of that instrument going forward. And so we see that relatively relaxed.
All right, Kristine, really appreciate your perspective. Great to get some time with you. That is Kristine Ulbrich. He is the president and CEO of JLL, joining us from Frankfurt, Germany. Meanwhile, we are just about 2 hours to go, actually just over 1 hour to go until the market closes. Time flies when you're having fun. Let's take a look at where we stand right now in the U.S. equity market. Taking a look at the S&P 500 right now, kind of an uninspired trade. We're higher by about 0.2%. Volume is bang in line with the 20-day average here. And we're coming off actually a weekly gain for the first full trading week of September. But we know seasonally speaking, this is a pretty hairy, scary time.
Yeah, and just want to call out that we are using that AVAT function on the terminal below average as it relates to trading volume. So relatively sleepy Monday in terms of trading activity, with kind of all eyes on tomorrow's jobs revisions number. We have, as we talked with Molly Smith, PPI and CPI data, and really just trying to get a sense of where inflation is, what that means for the Fed's decision later this month, and obviously how investors are going to position all around that, Katie, whether we get 25, 50, whatever.
Yeah, anything could happen, but probably 25 basis points. In any case, you might be wondering why Bailey and I are here, and here's the answer. It's because Carroll, Massar, and Tim Stenovec are at the Future Proofs conference in Huntington Beach, California, but they're here with us now. So Tim and Carroll, you're on another remote location here. What's going on over at Future Proof?
There are a lot of people at the beach, I can tell you that.
Which is right behind us.
Yeah, a lot of people at the beach. I saw some festival attendees that were wearing their, their tags, and then one guy carrying a surfboard early this morning.
Can I just tell
heading
you,
to the beach. This is like a great conference.
Tim's
That's what I'm going to say.
I got dressed. I brought my suit. Like, I should be wearing flip-flops. He does not have flip-flops on.
I'm the only one out of like 4,000 people around me wearing a suit right now. I feel a little overdressed, but hey, we got a great program coming up. We're taking full advantage of everyone who's here.
We are, and I love what you guys just talked about, everything that's coming at investors this week, right? Those jobs revisions. We've got a read on inflation. We have so much, it feels like, governments around the world. We've spent so much time talking about what's going on in France. There's just a lot coming at investors. So we are at an event where there's tons of RIAs, registered investment advisors. So they're trying to figure out, how do you make sense of all of the macro and figure out what's the best strategies, portfolio allocations for their clients.
Yeah, Lauren Goodwin is going to be joining us a little bit later. She's chief market strategist over at New York Life Investments. We're also going to be hearing from Barry Ritholtz a little later in the 4 o'clock hour. And then Sarah Levy over at Betterment. You know it as a robo-advisor, but increasingly they're offering services to RIAs with a Betterment Advisor solution. So we're going to speak to her about what they're doing right now.
Yeah, I'm really curious, too. We have the head of U.S. Wealth Advisory and head of retirement over at BlackRock. And you know that there's been a lot of news. They took over some of the wealth advisory for Citibank. That was news just last week. But also how BlackRock is increasingly wanting to offer private credit to their investors when it comes to long-term investment planning and retirement planning. So we're going to talk about that with her. And I'm assuming the Fed's going to come up a few times in our conversations, don't you think?
Yeah, I think so.
Just a few.
Yeah.
Well, the real question is, guys, it looks like it's sunny. Are you getting In-N-Out? Is In-N-Out being catered? That's all I really care about is what you guys are eating when you're in the better state of California.
You know, that's funny. Yeah, it's funny you say that, Bailey. No In-N-Out sightings yet. Some big burritos last night. Did a little trip to Balboa Island for frozen banana, the legendary frozen banana, which was pretty cool. I don't know. We have dinner tonight, Carol, so maybe we'll make our way to an In-N-Out burger.
I got to say that part of this event, what's interesting is, yes, it's all about the financial world, but it's also, there's food trucks, there's meditation on the beach in the morning, yoga on the beach. There's this kind of whole experiential part of this environment. Future Proof is very different from a lot of the other traditional investment conferences.
This is not a Las Vegas conference, that's what I'll say.
But they're all good. They're all good. Different perspectives. And that's why we're looking forward to see what kind of the mood is. I mean, last year we talked about the upcoming presidential elections. Well, now, as we all know, we have a new president in the White House, and he's certainly been impacting policy and the investment outlook. So we'll see what they have to say about it. All right, guys, back over to you.
All right. Really looking forward to the program that you guys have coming up. It sounds like you're working very, very hard out there in California. So we'll check in with Tim and Carol in just a little bit. We'll hand them the reins. But meanwhile, Billy and I are here and we're looking at markets. And I know that it is a big, important conversation that they're having out there with some of those RIAs about putting private assets in retirement plans. I have to imagine that is a hot topic among that crowd.
I mean, it's been a hot topic really here in New York on Wall Street is how can some of these private equity firms kind of monetize assets or open up the kind of portfolio to your average consumer, your people who are looking to retire and really enabling investments, whether that's private equity assets, whether that's venture capital backed assets. So certainly something to keep an eye on as they get better weather out there and better food. Personally, I'm biased.
There's no way Tim is eating an In-N-Out burger, though. I will just say that. I go by his desk. He's eating beets and raw chicken. Not raw, but close enough.
A healthy guy. He's a biker. I know you're a biker as well, so staying healthy.
Enjoy cardio.
All right.
Anyway.
Well, let's take a look at some stocks on the move today. I'm Bailey Lipschultz, and we're joined by managing editor for Bloomberg Markets live blog, Kristine Aquino. Kristine, what's top of mind?
Well, let's talk about EchoStar, shall we? That's probably one of the biggest pieces of news today, big in the M&A space. So EchoStar, ticker SATS, and those shares are up more than 17%. So pairing a little bit of the best of its performance today, but still pretty good. And that is because Elon Musk's SpaceX agreed to acquire the wireless spectrum licenses from EchoStar for about $17 billion. So that's going to give them the licenses designated for satellite and mobile communications. So this is according to a company statement, but it is actually, or was actually reported by Bloomberg earlier. So the good thing about this deal, at least from EchoStar's perspective, is that it should keep the FCC off their backs because the regulator has accused the company of not effectively using the spectrum that it was awarded and was actually threatening to strip some of its valuable licenses. So Bloomberg Intelligence weighing in on the deal, saying that it may materially reshape the company's credit profile because it enables significant debt reduction from its $27 billion loans. So that's quite a hefty load that is now being held by this deal.
Yeah, big move, though. This is a stock that is up almost 250% this year, but another stock that's rallying pretty hard today and this year, Robinhood. What's going on?
Absolutely. Robinhood, well, they're getting really good traction today. So extending those gains now up nearly 15% on the day. So Robinhood, ticker HOOD, really getting a boost today because of the news on Friday after the close saying that they have been added to the S&P 500 index. So, looking back 5 years ago, right, Robinhood was just this platform that mostly retail traders used. gained so much popularity, especially when people were sitting at home, bored during the pandemic and trying to figure out what to do with their stimulus checks. So fast forward 5 years later, now they're part of the S&P 500. And what's crucial about this is that inclusion allows them to enter the portfolios of index funds, pension plans, retirement accounts, a completely different investor base from the retail traders that are used to using the platform.
This is a stock that IPO'd at $38 right now, north of 115. Bring us on home, AppLovin.
AppLovin. So that is another stock that is getting that S&P 500 inclusion boost. So AppLovin, ticker APP. Those shares up more than 11% at the moment. So we know it's a mobile app marketing company and was also included in S&P 500. And, this is just the latest piece of good news for the company. Last month, we did see their second quarter results beating estimates. Bloomberg Intelligence also noting that their third quarter sales guidance implies 10 to 12% growth, which beats the consensus for 8% growth. And some of the features that they launched, including a self-service ad dashboard and AI-powered user acquisition tool, is really proceeding according to plan. So latest bit of good news for AppLovin there.
AppLovin at an all-time high. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Kristine, we have a busy week in terms of economic data. What are you keeping an eye on? What's kind of standing out when you look at this market right now?
Well, Bailey, I think you mentioned it earlier, right? The next milestone is, of course, going to be those job revisions. We'll see just how badly the labor market is doing. The thing is, it's doing just bad enough to convince potentially the Federal Reserve to cut rates as soon as this month, maybe a bit more over the next few months, but not so bad that investors are suddenly fearing a recession, So it's almost kind of like a Goldilocks sort of slowdown, if you will.
Well, we see, looking at the WERP function, we see markets pricing in a rate cut, obviously, in a little over a week and a half, and then really pretty much locking in another cut in October. It really seems like a question of, are we going to get 2 or 3 this year in terms of Fed rate cuts and what that really means for the market?
Yeah, absolutely. And of course, to answer that question, we will have another piece of data later this week. That's going to be PPI and CPI. Very, very important to answer the other side of the equation, right? Like how much the Federal Reserve can cut really depends on whether inflation is in check, because there's a lot of fears that, maybe there's kind of a later delayed reaction when it comes to the impact of tariffs, that there are lingering price pressures that risk getting reignited again. So that data is going to be very important for investors to see how the balance of jobs and labor market slowdown and inflation really goes before the Fed meeting next week.
Yeah, keeping an eye on markets, stocks trading higher. We are seeing a sell-off, though, in utilities and real estate, technology and consumer discretionary, leading to the upside. If you are watching us on YouTube or listening to us on radio, Bloomberg Businessweek Daily continues live from Future Proof in Huntington Beach, California, with Carol, Massar, and Tim Stenovec. If you're with us on Bloomberg Television, The Close is up next. This is Bloomberg.